Which is the better dividend stock, Caterpillar or Deere? That's the question I'm going to answer in this video. I'm going to compare these two dividend stocks across several important financial metrics, including their dividend yield and their valuation. So let's jump into this video. Let's compare these two excellent dividend stocks and answer which one is better for passive income investors today.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the first thing we look at is the dividend yield, and Caterpillar slightly better than Deere with a 1.61% dividend yield compared to Deere with a 1.38% dividend yield. Still, these dividend yields are not great, although investors buying these two dividend stocks can reasonably expect an increase in the dividend per share over the next 5, 10, 15 years. One of the reasons for that is when we consider the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. Okay, so now you know how that plays into dividend growth. You can see both Caterpillar and Deere in recent years have well outperformed their dividend per share in terms of earnings per share. Caterpillar, in its latest trailing 12-month period, had more than 4 times its dividend per share in earnings per share. Meanwhile, Deere had almost 7 times its dividend per share in earnings per share. Deere had an excellent growth in recent years. The macroeconomic factors worked strongly in Deere and Caterpillar's favor in recent years, although investors expect that to slow down. For Caterpillar, investors expect 0.5% revenue growth in 2024 and just 0.1% earnings per share growth. That's expected to grow to 2.2% for revenue and 4.1% for earnings per share, and again increase to 5.9% and 8% in 2026. Caterpillar is demonstrating what I call second derivative growth on both the top and bottom lines. That's a very attractive characteristic when you're considering a stock to invest. Meanwhile, Deere expected to decrease revenue by 13.5% in 2024 and earnings per share by 18.4%. 2025 is going to be better with 0.1% revenue growth and 1.7% earnings per share growth. And then again, revenue decrease in 26 with earnings per share increase in 2026. And you can understand that because look at how much Deere's revenue earnings per share, exploded from 2021 to 2023. It's reasonable to expect a little bit of a slowdown for Deere. I also want you to consider the cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. So now you understand the importance of this metric, and in this one, Caterpillar ahead of Deere, although not by much and not all the time. You can see in recent 2020 to 2022, Deere was better. And then in 2018 to 2019, Caterpillar was better. And then they were close. And so they fluctuate back and forth depending on the macroeconomic factors. But in recent year and a half, Caterpillar's been ahead 19.2%. compared to 14.2% for Deere. And I wouldn't be surprised if over the next 2 to 3 years, Caterpillar extends this lead given its better prospects over the next 2 years. And finally, let's look at valuation. And according to this metric, according to the forward price to earnings ratio, Deere is about 10% more expensive. Deere is about 10% less expensive than Caterpillar, with the forward PE of 14.43 for Caterpillar and 12.91 for Deere. So in my opinion, I think Caterpillar deserves this premium, right? We saw its cash flow from operations was better than Deere. We saw its prospects over the next 3 years are better than Deere's, with second derivative growth on the top and bottom line. So clearly, I'd rather have Caterpillar if I was a passive income investor looking for a dividend stock to buy today. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.